Okay, everyone, welcome to class, first of all. And on that list of items for learning modules for week one, what I want you to take out is the financial statement. I think it's called financial statement and ratios, but it's called reading and understanding financial statements. And you might want to look at that while we're going through this. What I want to point out, first of all, you'll see various items throughout the report. You want to, of course, read it all. But I just want to go over some account names with you. So the first actual financial statement we see is on page 6. It is a balance sheet. And let's go through that. It shows balance sheet for December 31st, 2009 and 2008. And first of all, under assets. Your assets must always equal your liabilities plus your shareholders' equity. So that must always be in balance after each and every transaction. Your current assets are those items that are either cash or will be turned into cash within the next accounting period, which for the most part is a 12-month period. So cash and cash equivalents, it's obvious what that is. Investment and trading securities, again, that spells out what it is. But where it shows accounts receivable less allowance for doubtful accounts. Doubtful accounts, that's something that you decide every year. There's a formula where you're going to determine which accounts you do not think will be collected. Those are doubtful accounts. We're not going to really go into that at all in this class, but accounts receivable is important. What an account receivable is for example, if I'm Lord & Taylor and you come in and you buy a shirt and you charge that on your Lord & Taylor account, it's an account receivable to me. I consider that the sale's been taken place and the actual transactions occurred, but I didn't get the money yet. What I have is an account receivable. What happens with accounting is it's based on accrual for the most part, for most organizations, rather than cash. So what accrual accounting says is basically at the time a sale actually occurs, whether or not the cash has passed hands, it's considered a sale. And that's why we have an account receivable at that point. Inventories, that's what we are selling. So if I sold these erasers, when I buy these erasers, let's say I bought 10, I hang on to them on my balance sheet. I consider that an asset. I hang on to that until I actually sell the item. Once I sell the item, it's released on the income statement as an expense in my cost of goods sold or cost of sales section. But initially when I buy it, before I sell it, it is considered an asset. And the reason for that is in accounting, you want to match your revenues with your expenses. Since I haven't generated a revenue yet, because I haven't sold that eraser, I'm not going to consider any of the expenses incurred in the actual purchase of that eraser. Or if I made them, the actual manufacturing of the eraser. Prepaid expenses, those are expenses that haven't been incurred yet, but I paid for them ahead of time. For example, prepaid insurance. If I pay for a whole year of insurance on January 1st, I haven't used it yet. So I'm going to hold on to it in my current assets section as prepaid insurance or prepaid assets until the point I actually incur the expense. At that point, I would transfer it from the balance sheet to the income statement as an expense, insurance expense, or it might be considered selling, general and administrative expenses, depending how the company allocates their expenses. But initially, if I haven't incurred the expense yet, it is considered an asset. Okay, you'll notice then they total all the current assets. And then under property and equipment, you're going to have your long-term assets. Those are assets that will not be turned into cash within the next accounting period. So we have land. Land, of course, we all know what land is. Land is not a depreciable asset, just so you know that. Buildings and improvements, we all know what buildings are. Machinery and equipment, again, we all know what that is. And then we have something here called accumulated depreciation, which I'm going to talk about, I'll talk about a little later. But what that is, again, when we buy these assets, let's say we buy something and it's going to last for 10 years. We are not going to expense it out on the income statement all at once. We're going to expense it out period by period by period. So then you'll see there's a total assets where it's, of course, adding up all the assets. The next section is our liabilities and stockholders' equity. Under current liabilities, we have a notes payable. That actually is very similar to an account payable, but it's more legal in nature. But let's say a notes payable might be I loan another company $1,000 for a month. That would be a note payable. If a note is short term, if it is expected to be collected within the next 12 months, it is considered a current liability. I then have current maturities of long-term debt. What that is, maybe I have a mortgage, for example, that's 30 years. But during this accounting period, during the next 12 months, I'm going to pay $5,000 of my mortgage off. I'm going to consider that a current maturity of the long-term debt. Next, we have accounts payable. What that is let's say I go to maybe Office Max and I buy a pen that I'm going to use in the daily basis of my business. It's just a supply. And I don't pay for it. I charge it on an Office Max account. That's an account payable to me. Transactions incurred, I have the item, but I haven't paid for it yet. And again, if I'm going to pay for it in the next 12 months, it's a current liability. Income tax payable, we all know what that is. And then they have various accrued expenses, and you'll see they add up total current liabilities. Other liabilities, they have long-term debt, net of current maturity. So that's long-term debt we're not paying off within the next 12 months. And then they have deferred income tax. They add it together, and that's their total other liabilities, and they add the current and the long-term together for total liabilities. Stockholders' equity, last section. You'll see they have 9.5% cumulative preferred stock at a par value of $10 and common stock at a par value of $1. So you'll see that total. What common stock is something you've sold. You're a public company, for example, let's say you're public, and I'm selling stock on the market, on the New York Stock Exchange. What a par value is just an arbitrary figure. Certain states require it. Other states it is not required to have any par value, but a company still might have something called a stated value. But what that is an arbitrary value I assign to my stock. It is not what it sells for. So you will see an account below that called additional paid-in capital. So let me explain the difference between the two. So let's say I have stock. I'm going to these are all the ratios. I already put them up, but I'll just put this in the corner. Let's say I sell stock, one share, and my par value is $1. I would have common stock here for $1. But let's say it sells on the open market for $10. That's going to be my additional paid-in capital. So I would have additional paid-in capital. It's selling for for 10, and my par is 1. Additional paid-in capital for that share of stock is 9. So that's all it means. It's what the actual par value is. That's my common stock. My additional paid-in capital is the difference between the par value and what it's sold for. Next is retained earnings.